Welcome Vorldrevolution to this audiobook summary of Rich Dad's Guide to Investing. What the Rich Invest and That the Poor and Middle Class Do Not, by Robert Kiyosaki and Sharon L. Lechter. Over the next hour, we're going to dive deep into the world of wealth building as seen through the eyes of Robert Kiyosaki, a man who turned lessons from his rich dad into a financial empire. This isn't just a book about stocks or real estate. It's a guide to rethinking how you approach money, investing, and your own potential. Whether you're new to investing or looking to level up, buckle up. We're about to explore what sets the rich apart and how you can join their ranks. Let's get started. Introduction: A tale of two dads and a financial awakening. Imagine growing up with two father figures. One, a highly educated man who worked hard but struggled financially. Robert calls him his poor dad. And the other, a savvy entrepreneur who built wealth through business and investments, known as his rich dad. This is where Robert Kiyosaki's journey begins, and it's the foundation of Rich Dad's Guide to Investing. Published in 2000 as the third installment in the Rich Dad series, this book builds on the lessons of Rich Dad, Poor Dad, and Cash Flow Quadrant, taking us from financial literacy to the art of becoming a sophisticated investor. The subtitle promises to reveal what the rich invest and that the poor and middle class do not, and Kiyosaki delivers by pulling back the curtain on the mindset, strategies, and opportunities that define wealth creation. He's not here to give you a get-rich-quick scheme. Those don't exist, he says. Instead, he offers a roadmap, a guide inspired by his rich dad's teachings, to help you think and act like the wealthy. So what's the big idea? It's simple yet profound. Investing isn't just about money. It's about education, experience, and leveraging opportunities most people overlook.
I hope that you've enjoyed this video, and please remember to subscribe to receive notification of upcoming recordings.
Phase 1. Are you mentally prepared to be an investor? Let's start with the first phase of the book, mental preparation. Kiyosaki kicks things off with a question. Are you ready to think differently? Rich Dad believed that 90% of people share just 10% of the world's wealth, while 10% control 90%. This isn't luck, it's a pattern rooted in how people approach money. Poor Dad, the traditionalist, preached job security, saving, and avoiding risk. Rich Dad, on the other hand, saw money as a tool and risk as an opportunity. One of the first lessons is about overcoming fear and laziness, two mental barriers that keep most people average. Kiyosaki recalls a moment from his childhood when Rich Dad asked, "What advice would you give the average investor?" His answer: "Don't be average. To escape the rat race, you need to shift your mindset from earning a paycheck to building assets. Assets," he explains, "put money in your pocket, like rental properties or businesses, while liabilities, like a fancy car or a big house, take money out." This distinction, introduced in Rich Dad, Poor Dad, is the bedrock of everything that follows. But mental preparation goes beyond definitions. It's about asking yourself, why do I want to be rich? Kiyosaki insists you need a burning reason, a personal why, to push through challenges. For him, it was freedom from financial struggle after sleeping in his car with his wife Kim in the 1980s. What's your why? That's your fuel. Let's deep dive in more detail. The foundation: a tale of two mindsets. Picture this: a young Robert Kiyosaki growing up in Hawaii with two father figures shaping his view of money. There's his poor dad, his biological father, a PhD, a superintendent of education, a man who climbed the ladder of hard work and still ended up broke. Then there's Rich Dad, his best friend Mike's father, a high school dropout turned entrepreneur who owned businesses, properties, and a fortune. These two men didn't just differ in wealth. They saw the world through completely different lenses. And that, Robert says, is where investing begins, with how you think. In Phase 1, Kiyosaki sets the stage by asking a big question. Are you mentally ready to break free from the 90% who share just 10% of the world's wealth? Rich Dad had a theory. Money flows to the 10% not because they're luckier or smarter, but because they think differently. Poor Dad's advice was the gospel of the middle class. Get a good job, save every penny, avoid risk like it's the plague. Rich Dad? He saw jobs as temporary, savings as a slow leak, and risk as the doorway to riches. This clash of philosophies isn't just a story, it's a wake-up call. The mental barriers: fear, laziness, and excuses. So what's holding most people back? Kiyosaki points to two culprits: fear and laziness. Fear whispers, "What if I lose everything?" Laziness says, "It's too hard. I'll start tomorrow." Together, they keep you average. Rich Dad once told Robert and Mike, "The reason most people don't get rich is they're afraid of losing, and losing is part of winning." It's a paradox the middle class rarely grasps. Take an example from the book, Robert recalls a neighbor in his 20s, a guy with a steady job who dreamed of buying rental properties. But every time he saved a little, fear kicked in. What if the tenant doesn't pay? What if the market crashes? And laziness followed. I'll figure it out later. Years passed, and he stayed stuck, watching others build wealth. Contrast that with Robert and his wife Kim. In the 1980s, they hit rock bottom, sleeping in a beat-up Toyota after a business flop. Fear was there, sure, but they pushed through. Kim took a bookkeeping course. Robert studied real estate. They scraped together $2,000 for a tiny rental property. That first step, born from grit not cash, sparked their climb. The power of why. Finding your fuel. Mental preparation isn't just about conquering fear, it's about igniting desire. Rich Dad asked Robert a question that stuck with him. Why do you want to be rich? It's not enough to say more money. You need a visceral, personal reason to weather the storms. For Robert, it was freedom. Freedom from the humiliation of poverty, from the grind of a 9 to 5 he hated. After that car-sleeping stint, he vowed never again. That why drove him to take risks poor Dad would have called crazy. Let's bring this home with an example. Imagine Sarah, a single mom working retail. She's tired of barely paying rent, of telling her kid no to extras like soccer camp. Her why might be giving her son a better shot, maybe a college fund or a home of their own. That's her fuel. Kiyosaki says without it, you'll quit when the going gets tough. Sarah could start small, flipping thrift store finds online, saving for a duplex down payment. Her why turns a pipe dream into a plan. Assets versus liabilities, rewiring your money map. Here's where the rubber meets the road, rethinking money itself. Poor Dad saw a paycheck as the goal. Work hard, spend wisely, save what's left. Rich Dad flipped the script. Money's a tool, and the game is assets versus liabilities. An asset, he taught, puts money in your pocket, like a rental unit or a business. A liability takes it out, like a car payment or a bloated mortgage. Most people, Kiyosaki argues, think they're investing when they're just buying liabilities. He shares a classic story from his youth. At 15, he begged Rich Dad to teach him about money. Rich Dad handed him a ledger from one of his convenience stores and said, "Figure it out." Robert saw cash flowing in from sales, out to suppliers, and left over as profit, an asset at work. Compare that to poor Dad, who bought a bigger house after a promotion, thinking it was an investment. Taxes, upkeep, and a fat mortgage ate his salary. Classic liability trap. Robert realized, the rich by income, the middle class by expenses. Let's ground this with an example. Meet Tom, a teacher with $50,000 saved. Option 1. He buys a flashy boat to invest in happiness. Payments and maintenance drain his account, liability. Option 2. He puts that $50,000 down on a $200,000 duplex, rents it out, and nets $500 a month after the mortgage, asset. 5 years later, the boat's a rust bucket. The duplex is paid down and worth $250,000. That's the mental shift Kiyosaki demands. Don't be average, the first commandment. Rich Dad had a blunt piece of advice for the average investor. Don't be average. Average means following the crowd, saving for decades, hoping a 401k saves you, praying the market doesn't tank. Kiyosaki saw this firsthand with poor Dad's friends. Decades of toil, then retirement on a shoestring. Rich Dad's crew? They owned warehouses, restaurants, stocks before they went public. The difference wasn't IQ. It was courage and curiosity. Consider Jane, an office worker in her 30s. Average Jane socks away $200 a month in a mutual fund, earning 5% if she's lucky. 40 years later, she's got $265,000. Decent, but not rich. Now meet bold Jane. She takes a real estate seminar, buys a $100,000 fixer-upper with a loan, rents it for $1,200 a month. After expenses, she nets $400 monthly, reinvests in another property, and in 15 years owns 5 homes worth $750,000, pulling $24,000 a year in passive income. Same starting point, different mindset. Overcoming the I can't trap. Kiyosaki doesn't sugarcoat it. Excuses are the enemy. I don't have money. I'm not smart enough. It's too late. He's heard them all. Rich Dad's comeback? Stop saying, I can't, and start asking, how can I? Robert shares how he flipped this script. Broke in his 30s, he didn't moan. He asked, how can I turn $2,000 into more? The answer was that first rental property, a beat-up condo he fixed and flipped into cash flow. Try this with Mark, a mechanic earning $40,000 a year. I can't invest. I've got bills, he groans. Shift the question, how can I? He starts a side gig fixing cars at home, saves $5,000, buys a cheap lot, builds a small rental with sweat equity. 5 years later, He's got $1,000 monthly income. It's not millions, but it's a start, proof that how beats that can't. Wrapping up Phase 1, your mental checklist. As Phase 1 closes, Kiyosaki leaves you with a challenge. Audit your mind. Are you ruled by fear or fueled by purpose? Do you see money as a paycheck or a tool? Are you ready to ditch average for extraordinary? He doesn't expect you to be a tycoon tomorrow. Mental prep is step 1. Robert and Kim weren't either. They were broke and scared, but they chose to think like Rich Dad. That choice, education over excuses, assets over liabilities, launched them. So ask yourself, what's my why? What's one liability I can ditch, one asset I can chase? Maybe it's selling that gas guzzler for a down payment, or reading a book on stocks instead of scrolling TV. Phase 1 isn't about action yet. It's about rewiring your brain for what's next. Get that right, and you're on your way. Phase 2. What kind of investor do you want to be? Now that your mind's in gear, Kiyosaki moves to the types of investors. He outlines a spectrum, from the novice to the elite, and challenges you to decide where you want to land. Most people, he says, are outside investors. They buy mutual funds or stocks through a broker, hoping for the best. It's passive, low risk, and often low reward. The rich, however, play a different game. First, there's the accredited investor, someone with a high income or net worth, legally allowed into exclusive deals like pre-IPO stocks. Then, the qualified investor, who studied markets and can spot trends. Next, the sophisticated investor, who uses leverage and tax strategies to maximize returns. The inside investor creates their own assets, like starting a business or buying real estate to control. Finally, the ultimate investor builds empires. Think IPOs or massive real estate portfolios that generate wealth for generations. Kiyosaki's point? The rich don't just buy investments, they create them. Take his own story. After failing with a surfer wallet business, he rebuilt with a t-shirt company, then pivoted to real estate and education. Each step made him an inside investor, not a bystander. You don't need millions to start, just the willingness to learn and act. Let's deep dive in more detail. The investor spectrum. Where do you stand? Phase 2 kicks off with a reality check. Not all investors are created equal. Kiyosaki learned this watching his two dads. Poor dad wasn't much of an investor. He stashed cash in a savings account and called it a day, hoping hard work would cover retirement. Rich dad, though, played a different game, building businesses and buying properties that worked for him. That contrast inspired Robert to map out a ladder of investor types, each rung representing a leap in control, knowledge, and payoff. The question is, where are you now, and where do you want to climb? Kiyosaki starts with the majority, the outside investor. These folks hand their money to someone else, a broker, a mutual fund, and cross their fingers. It's low effort, low risk, and usually low reward. Then there's the accredited investor, someone with enough income or net worth to unlock exclusive deals, like private equity. Next up, the qualified investor, who studied markets and can spot a gem. The sophisticated investor takes it further, mastering leverage and tax tricks. The inside investor creates their own assets. Think starting a company or buying a building to control. Finally, the ultimate investor builds empires that reshape the game, like taking a business public. Rich Dad's goal? Push Robert to the top. Let's break these down. The outside investor, playing it safe. Most people start here, outside investors. They dip a toe in the water with a 401k, a few stocks, or a mutual fund picked by their bank guy. Kiyosaki doesn't knock it. It's a start, but he warns it's passive. You're betting on someone else's smarts, not yours. He shares a memory of poor dad's colleagues, teachers who squirreled away savings in safe funds. By retirement, inflation had nibbled half their nest egg away. Safe? Sure. Rich? Not a chance. Take Lisa, a nurse in her 40s. She puts $300 a month into a stock index fund, averaging 6% a year. After 20 years, she's got $137,000. Nice, but she's still working. Lisa's an outside investor. Low control, modest gains. It's the middle-class default, and Kiyosaki says it's fine if you're happy staying there. But the rich? They don't wait for Wall Street. They make their own waves. Accredited investor, the VIP pass. Step up to the accredited investor, someone earning $200,000 a year solo, or $300,000 with a spouse, or sitting on a $1 million net worth, excluding their home. This isn't about skill yet. It's about cash flow or assets, a legal threshold set by the SEC. Why? Because it unlocks doors, private placements, hedge funds, pre-IPO stocks, the stuff average Joes can't touch. Rich Dad loved this level. It's where he started dabbling in early-stage companies. Robert recalls a deal Rich Dad jumped on, a small tech startup needing cash in the 70s. He plunked down $25,000, an accredited-only offer, and when it went public, that turned into $250,000. Risky? Yes, but the payoff beat any mutual fund. Imagine Alex, a dentist making $250,000 annually. He qualifies as accredited and invests $50,000 in a real estate syndicate, a private deal for a new apartment complex. 3 years later, it's sold, and he pockets $80,000. Alex didn't pick the property. He just had the ticket to ride. Qualified investor. Knowledge is power. Now we're cooking, the qualified investor. This isn't about money in the bank. It's about money in your head. These folks study financial statements, track market cycles, and sniff out trends. Rich Dad drilled this into Robert. Don't trust a hot tip. Trust your homework. One day, he handed Robert a stack of annual reports and said, "Find me a winner." Hours later, Robert spotted a company with rising cash flow and low debt, a diamond in the rough. Rich Dad bought in and doubled his money in a year. Meet Priya, a software engineer earning $120,000. She's not accredited yet, but she's qualified. She spends weekends learning stock analysis, spots a biotech firm with a promising drug trial, and buys $10,000 in shares at $5 each. A year later, it's $15, $30,000 total. Priya's edge? She didn't guess. She knew. Qualified investors thrive on education, not luck. Sophisticated investor, leverage, and strategy. Next rung, the sophisticated investor. These are the pros, folks who blend knowledge with strategy, using debt, tax laws, and creative deals to juice returns. Rich Dad shown here. Robert tells of a rundown warehouse Rich Dad bought for $100,000 with a $20,000 loan. He fixed it up, leased it to a retailer, and sold it for $250,000, all while writing off repairs on his taxes. Net profit after the loan, $120,000 on a $20,000 outlay. That's sophistication, turning small cash into big wins. Consider Miguel, a contractor with $80,000 saved. He studied real estate and tax code. He buys a $400,000 triplex with a $60,000 down payment, rents it for $4,000 a month, and clears $1,500 after the mortgage. Depreciation cuts his taxes, and in 5 years, it's worth $500,000. Miguel's not just investing. He's engineering wealth with leverage and loopholes. Inside investor, creating your own game. Here's where the rich really pull ahead, the inside investor. These folks don't buy assets, they build them. Start a business, flip a property, control the outcome. Robert's own story fits here. After a failed surfer wallet venture, he launched a t-shirt company with Kim in the 80s. They designed, marketed, and sold it themselves, growing it to $1 million in sales before selling. Later, they bought distressed real estate, renovated, and rented. Inside moves with full control. Picture Jenna, a baker tired of her day job. She starts a cupcake side hustle, grows it to $50,000 a year, then opens a storefront with a $30,000 loan. 3 years later, it's netting $100,000 annually. She's not betting on stocks, she's her own stock. Inside investors like Jenna and Robert create value, not just chase it. Ultimate investor, building an empire. Finally, the pinnacle, the ultimate investor. These are the titans. Think Elon Musk launching Tesla or Rich Dad dreaming of an IPO. They don't just play the game, they rewrite the rules. Kiyosaki admits he's not fully there yet, but his Rich Dad brand is a step. He turned books into a global education empire, pulling in millions. Rich Dad aimed for this too, once eyeing a chain of stores to take public. Imagine Raj, a tech founder. He bootstraps an app with $10,000, scales it to 1 million users, raises venture cash as an accredited deal, then IPOs at a $500 million valuation. His $10,000 stake becomes $50 million. Ultimate investors don't just win, they redefine winning. Choosing your path. Where do you aim? Phase 2 ends with a nudge. Pick your spot. Outside investors stay comfortable. Accredited ones buy access. Qualified ones hunt value. Sophisticated ones multiply it. Inside ones create it. Ultimate ones dominate it. Robert didn't jump straight to inside. He started small, buying an $18,000 condo with Kim, learning as he went. The key? Decide, then climb. Take Sam, a teacher with $20,000. Outside, he picks a fund. Accredited isn't an option yet. Qualified, he studies and buys a cheap stock. Sophisticated, he leverages into a duplex. Inside, he starts a tutoring gig to sell later. Ultimate, he dreams of a school chain. Sam's choice shapes his future. Yours does too. Phase 3, building your financial foundation. Here's where the rubber meets the road, building your base. Kiyosaki introduces 3 pillars: education, experience, and excessive cash, that he calls the 3 E's. Let's break them down. Education isn't about a college degree, it's financial literacy. Rich Dad taught Kiyosaki to read financial statements, understand tax laws, and spot opportunities. One anecdote stands out. As a young man, Kiyosaki sat with Rich Dad and his friend Mike, reviewing a complex investment prospectus. Overwhelmed, he zoned out, until Rich Dad pointed to a line about accredited investors only. It hit him. The best deals were locked away from the average person. Education, he realized, was the key to unlock them. Experience comes from doing. Start small, maybe a side hustle or a rental property. Kiyosaki suggests keeping your day job while you build, a practical tip he followed himself. His t-shirt business didn't make him rich overnight, but it taught him sales, negotiation, and resilience, skills he later used to buy real estate. Excessive cash isn't about hoarding. It's about generating surplus through passive income. Rich Dad's mantra was pay yourself first. Before bills or taxes, invest in assets. Over time, those assets, like a business or property, create cash flow, freeing you to invest more. Kiyosaki's own journey from broke to multimillionaire proves it's a long game, not a sprint. Let's deep dive in more detail. The 3 pillars, your wealth blueprint. Phase 3 is where the rubber meets the road. You've got the right headspace and a vision of who you want to be as an investor. Now you need a solid footing. Kiyosaki calls it the 3 E's: education, experience, and excessive cash. Think of them as the legs of a tripod. Skip one, and the whole thing topples. Rich Dad hammered this into Robert. Wealth isn't a lottery ticket. It's a structure you construct, brick by brick. Poor Dad missed this, relying on a paycheck and a pension that barely stretched. Rich Dad built a foundation that grew into millions. Let's break it down, pillar by pillar. Pillar 1, education, the key to seeing opportunity. First up, education. Not the classroom kind. Poor Dad had a PhD and still struggled, but financial literacy. Rich Dad taught Robert that money talks, and you've got to speak its language. That means understanding financial statements, tax codes, market trends, and deal structures. It's not sexy, but it's power. Kiyosaki shares a vivid memory. At 15, Rich Dad plopped a thick investment prospectus on the table, pages of numbers and jargon about a private stock deal. Robert's eyes glazed over until Rich Dad pointed to a line. For accredited investors only. It clicked. The best opportunities were gated behind knowledge, not just cash. He tells another tale. In his 20s, he sat with Rich Dad and Mike reviewing a rental property's books. Rent came in, expenses went out, profit stayed. Simple, but profound. Poor Dad never read those numbers. He just paid bills. Education let Robert see what others missed. Take Maria, a barista earning $30,000 a year. She grabs a library book on real estate, learns about cash-on-cash return, and spots a $50,000 condo with a $5,000 down payment. Rent covers the mortgage, and she nets $200 a month. Without that book, she'd have missed it. Education isn't a degree, it's eyes wide open. Pillar 2, experience, learning by doing. Next, experience. You can read all the books, but wealth comes from action. Rich Dad's rule: start small, learn fast, scale up. Robert's first taste came young. He and Mike ran a comic book rental gig at 9, charging kids a dime to borrow. It flopped when the school shut it down, but the lesson stuck. Try, fail, adjust. Fast forward to his 30s. Broke after a wallet business tanked. He and Kim bought a $18,000 condo with $2,000 down. They fixed it, rented it, and flipped it into cash flow. That hands-on grind taught him more than any seminar. Kiyosaki stresses keeping your day job while you build. Practical advice he followed. His t-shirt venture in the 80s started as a side hustle while he worked odd jobs. Sales, negotiation, setbacks, it all built his chops for bigger plays. Let's meet Jamal, a mechanic with $10,000 saved. He starts a weekend car flipping gig, buys a junker for $2,000, fixes it, sells for $4,000. First deal's a mess. He barely breaks even. But by the 5th, he's netting $1,500 a pop. Experience turns theory into muscle memory. Jamal's not rich yet, but he's learning the game. Pillar 3, excessive cash, the fuel for growth. Finally, excessive cash. This trips people up. Kiyosaki doesn't mean a fat savings account. He means cash flow you don't need to live on. Rich Dad's mantra was pay yourself first. Before bills, taxes, or groceries, funnel money into assets. Over time, those assets, say, a rental or a business, spit out surplus cash to reinvest. Robert saw this with Rich Dad's convenience stores. Profits didn't sit. They funded more stores, then warehouses, then stocks. Poor Dad. His salary went to a bigger house and a car, gone. Robert's own path proves it. That first condo's $200 monthly profit didn't buy lattes, it bought a second property. By his 40s, he and Kim had dozens, generating thousands in excessive cash monthly. Here's an example. Meet Tara, an office manager earning $50,000. She saves $5,000, buys a $100,000 duplex with a loan, rents it for $1,200 a month, clears $400 after expenses. Instead of spending it, she saves another $5,000, buys another. 5 years later, she's got 3 units, $1,200 monthly cash flow, excess she reinvests. It's not instant millions, it's a snowball rolling downhill. Tying the 3 yes together, real-life foundations. The magic happens when the 3 yes sync. Robert shares a turning point. In the 80s, he and Kim were broke, sleeping in a car. Education came first. Kim learned bookkeeping. He studied real estate. Experience followed. They bought that $18,000 condo, fumbling through repairs and tenants. Excessive cash trickled in, $200 here, $300 there, until it funded bigger deals. By their 50s, they owned millions in assets. It wasn't luck, it was a foundation. Consider Luis, a teacher with $15,000. Education. He takes a free online course on stocks, learns PE ratios. Experience. He invests $5,000 in a solid company, tracks it, sells for $7,000. Excessive cash. He reinvests the $2,000 profit, buys a $50,000 rental with a loan, nets $300 a month. 5 years on, he's got $20,000 in stocks and 2 rentals pulling $600 monthly. Luis's foundation isn't flashy, but it's rock solid. Proof the 3 yes scale with effort. Overcoming the I don't have enough myth. Kiyosaki tackles a common whine. I don't have enough. To learn, to start, to invest. Rich Dad's reply? You don't need much, just enough to begin. Robert started with $2,000 and a beat-up condo. Rich Dad began with 1 store. Take Priya, a cashier with $1,000. Education, she watches YouTube videos on e-commerce. Experience, she spends $500 on thrift store clothes, resells online for $800. Excessive cash, she reinvests the $300, grows to $2,000 profit in a year. Small start, big potential, because she built a foundation, not excuses. The long game, your foundations pay off. Phase 3 wraps with a promise. Get the 3 yes right, and you're set to climb Kiyosaki's investor ladder. Education spots the deals, like Rich Dad's warehouse buys. Experience hones your gut, like Robert's t-shirt hustle. Excessive cash fuels the leap, like Kim and Robert's real estate empire. It's not overnight. Robert admits he stumbled for a decade, but it's steady. Poor Dad never built this base. He chased security, not growth. Rich Dad did, and it paid off. So, your move. What's one thing you can learn this week? A tax trick? A market basics video? 1 action to try. Sell something online, shadow a landlord? $1 to redirect. Skip the takeout, stash it for an asset? Phase 3 says start where you stand. Build that tripod, and you're not just dreaming of wealth, you're laying its foundation. What the rich invest in. Now, the million-dollar question. What do the rich invest in that others don't? Kiyosaki reveals it's less about specific assets and more about strategy. Average folks buy stocks or mutual funds after they're hot, outside investing. The rich, though, go inside. Business ownership is a big one. Start a company, grow it, then sell it or take it public. Kiyosaki did this with his Rich Dad brand, turning books into a global franchise. Real estate is another favorite. Buy low, improve, and rent or sell high. He shares how he and Kim bought distressed properties in the 80s, turning them into cash machines. Pre-IPO investments let the rich get in early on startups, reaping huge gains when they soar. And hedges, like short selling or put options, let them profit when markets crash, something the middle class rarely considers. The difference isn't just the assets, it's control. The rich don't wait for Wall Street. They create their own opportunities. Kiyosaki admits this takes guts and know-how, but that's why the 3 yes matter. The big reveal. It's about control, not just cash. Here's the headline of this section. The rich don't just invest in different things, they invest differently. Kiyosaki hammers this home with the book's subtitle, What the Rich Invest in That the Poor and Middle Class Do Not. It's not a secret asset class locked in a vault. It's a mindset of control and creation. Poor Dad parked his money in a savings account or a safe, mutual fund, hoping for 3% a year. Rich Dad? He sought assets he could shape, businesses he built, properties he flipped, deals he structured. The average person buys what's hot. The rich create what's next. Robert learned this watching Rich Dad turn a single convenience store into a chain, then a real estate portfolio. It wasn't about having millions. It was about seeing beyond the stock ticker. The rich invest in opportunities they can influence, not just ride. Let's break it down into the big four: business ownership, real estate, pre-IPO deals, and hedges. These are the playgrounds of the wealthy, and we'll see why with some real-world flavor. Business ownership, building your own money machine. First up, business ownership. The rich don't just work for money. They make money work for them by creating companies. Rich Dad loved this. He started with a store, grew it, then sold pieces or expanded. Robert followed suit. After a flop with a surfer wallet business in the 70s, he and Kim launched a t-shirt company in the 80s. They designed funky prints, hustled at trade shows, and built it to $1 million in sales before selling. Later, the Rich Dad brand turned books into a global education empire. Why businesses? Control. You set the value, scale it, and cash out, or keep the profits flowing. Take Jamal, a mechanic tired of fixing cars for someone else. He starts a repair shop with $10,000, grinds weekends, and nets $50,000 a year by year 2. 5 years in, it's worth $200,000. He could sell or hire a manager and pocket passive income. Contrast that with his buddy Tom, who puts $10,000 in a stock fund and waits. Jamal's in the driver's seat. Tom's a passenger. The rich invest in businesses because they're assets they can steer. Real estate, cash flow, and leverage. Next, real estate. Kiyosaki calls it the ultimate asset for the rich, tangible, controllable, and ripe for leverage. Rich Dad bought rundown buildings cheap, fixed them, and rented them out, like a warehouse he snagged for $100,000, leased for $2,000 a month, then sold for $250,000. Robert and Kim mastered this too. In the 80s, broke and desperate, they bought an $18,000 condo with $2,000 down. They renovated it, rented it for $300 a month, and used the profit to buy more. By their 50s, they owned millions in properties. Why real estate? It's not just appreciation, though that's nice. It's cash flow and debt. Banks lend big on property, letting you control a $100,000 asset with $20,000. Rent pays the loan, and you keep the surplus. Meet Sarah, a teacher with $15,000 saved. She buys a $75,000 duplex with a loan, rents it for $1,000 a month, clears $400 after expenses. 5 years later, it's worth $90,000, and she's got $24,000 in equity plus cash flow. The middle class buys a house to live in. The rich buy houses that pay them. Pre-IPO investments, getting in early. Now, pre-IPO investments, stocks before they hit the public market. This is accredited investor territory, where the rich get first dibs on startups or private firms. Rich Dad jumped on these when he could, like that $25,000 stake in a tech company in the 70s that ballooned to $250,000 at IPO. Robert saw the power too. Exclusive deals often multiply faster than public stocks. Why? You're in at ground zero, before the crowd bids up the price. Picture Alex, a dentist earning $250,000 a year. He qualifies as accredited and invests $50,000 in a biotech startup via private placement. 2 years later, it goes public, and his stake's worth $150,000. Compare that to Lisa, who buys the same stock post-IPO at $20 a share. It climbs to $30, turning her $50,000 into $75,000. Alex triples his money. Lisa's up 50%. The rich invest early because the biggest gains come before the bell rings. Hedges, profiting when others panic. Here's a curveball. Hedges. The rich don't just ride bull markets. They profit in crashes too. Think short selling, betting a stock will drop, or put options, insurance against a fall. Rich Dad taught Robert to see both sides of the coin. When a local retailer overexpanded, Rich Dad shorted its stock, making $50,000 when it tanked. Most folks lost their shirts. He cashed in. It's not gambling. It's strategy, using market swings to win either way. Consider Priya, a tech worker with $20,000 in savings. She learns options trading, buys puts on a hyped-up stock at $100 a share. It flops to $60, and her $2,000 bet pays $10,000. Her co-workers, holding the stock, lose big. She profits. The middle class prays for up, the rich play up and down. Hedges take guts and know-how, but they're a Rich Dad favorite. The difference? Creation over consumption. What ties these together? The rich invest in control and creation, not consumption. Poor Dad bought a mutual fund and waited. Rich Dad built a store and shaped its fate. Robert didn't chase hot stocks. He made the Rich Dad brand a cash cow. Real estate's not just a house. It's a system you tweak. Pre-IPOs and hedges? They're insider moves, not crowd bets. Take Luis, a cashier with $5,000. He could buy a stock or start a side hustle selling crafts online, growing it to $20,000 a year. The rich pick the latter, assets they mold. Kiyosaki admits it's not easy. His t-shirt gig floundered before it flew. Early properties had leaky roofs and deadbeat tenants. But control beat passivity every time. The middle class asks, what's the safest fund? The rich ask, what can I build or leverage? Bringing it home, your rich investor move. So what do the rich invest in? Businesses they run, properties they improve, startups they seed, and hedges they wield. It's less about the what and more about the how. Active over passive, inside over outside. Robert's empire started with a $2,000 condo. Rich dads with a single store. You don't need millions, just a shift. Imagine Tara, an office worker with $10,000. She could buy a stock or use $5,000 for a real estate course and $5,000 for a rental down payment. 5 years later, she's got $500 a month in cash flow. That's rich investing. Small start, big control. What's your move? Skip the hot tip. Find an asset you can shape. The 10 investor controls, mastering your destiny. Midway through, Kiyosaki lays out his 10 investor controls, practical steps to take charge of your financial future. Here's a quick rundown. 1. Control over yourself. Master your emotions and habits. 2. Control over income/expense ratios. Live below your means, invest the rest. 3. Control over when you buy, sell, time markets, or assets wisely. 4. Control over your team. Surround yourself with experts, lawyers, accountants, brokers. 5. Control over information. Stay ahead with research. 6. Control over diversification. Spread risk across assets. 7. Control over cash flow. Build passive income streams. 8. Control over taxes. Use legal loopholes, like business deductions. 9. Control over leverage. Borrow smartly to amplify returns. 10. Control over your legacy. Plan for wealth beyond your lifetime. These aren't abstract. They're Kiyosaki's playbook. When he bought his first rental property, he relied on a team, timed the market, and used debt wisely. It's methodical, not magical. The power of control, from passenger to pilot. Halfway through the book, Kiyosaki drops a bombshell. The rich don't just invest, they control their investments. Poor dad handed his money to a bank or a broker, crossing his fingers. Rich dad? He called the shots. Robert learned this the hard way. After flops and wins, he realized waiting for luck was a loser's game. The 10 investor controls are his answer, practical steps to grab the reins. These aren't theories. They're how he and Kim went from sleeping in a car to owning millions. Let's break them down, one by one, with stories and examples to bring them alive. 1. Control over yourself, the first battleground. It starts with you. Emotions, fear, greed, laziness, can tank your wealth faster than a bad stock. Rich dad told Robert, master yourself, or the market will. When Robert and Kim bought their first $18,000 condo in the 80s, fear screamed, what if it fails? They pushed through, and it paid off. Self-control meant sticking to the plan. Take Sarah, a nurse with $5,000 saved. She's tempted to splurge on a vacation, but reins it in, investing in a stock instead. A year later, it's $6,000. Control over herself, saying no to instant gratification, starts her journey. 2. Control over income/expense ratios. Lie below, invest above. Next, your money flow. Rich dad's rule. Spend less than you earn, invest the rest. Robert saw poor dad's trap. Every raise meant a bigger house, more bills. Rich dad kept expenses low, pouring surplus into assets. Robert and Kim lived cheap early on, funneling every spare dime into properties. Meet Jamal, a mechanic earning $40,000. He cuts cable and eats out less, saving $500 a month. That funds a $20,000 rental down payment, netting $200 monthly. Controlling his ratios turns wages into wealth. 3. Control over when you buy, sell. Timing is everything. Timing matters. The rich don't chase hype. They wait for value or strike when others panic. Rich dad bought a warehouse during a downturn for $100,000, sold it later for $250,000. Robert learned this buying real estate in the 80s crash, cheap deals that soared later. Priya, a tech worker, watches a stock drop from $50 to $30 during a dip. She buys $5,000 worth, sells at $45 a year later for $7,500. Controlling when she acts beats the crowd's rush. 4. Control over your team. Surround yourself with pros. No one wins alone. Rich dad had lawyers, accountants, and brokers, experts who amplified his moves. Robert built his own crew. Kim handled books. A realtor found deals. When he bought that first condo, a savvy agent tipped him off. Luis, a teacher, wants a rental. He hires a tax pro who saves him $2,000 yearly and a broker who nabs a $50,000 gem. His team doubles his edge. Control your squad, and they lift you up. 5. Control over information. Knowledge is your edge. Ignorance kills returns. Rich Dad devoured financial reports. Robert studied markets before buying. When he had a t-shirt business, he researched trends. Velcro wallets were out. Funky tees were in. It paid off. Tara, an office worker, learns real estate basics online. She spots a $75,000 duplex others miss, buys it, and nets $300 a month. Controlling info turns blind spots into gold mines. 6. Control over diversification. Spread smart, not thin. The rich diversify, but not like the middle class's safe funds. Rich Dad mixed stores, properties, and stocks, each chosen for cash flow or growth. Robert spread bets across real estate in his Rich Dad brand. Alex, a dentist, puts $50,000 in a startup, $30,000 in a rental, $20,000 in stocks. One flops, but the others thrive, netting $15,000 yearly. Controlled diversification balances risk and reward. 7. Control over cash flow. Build the passive pipeline. Cash flow is king. Rich Dad's stores and rentals paid monthly. Robert's properties did too. That first condo's $200 a month funded the next. It's not about hoarding, it's about streams. Maria, a barista, buys a $50,000 condo with $5,000 down, rents it for $600, clears $200 after the loan. She reinvests, grows to $600 monthly. Controlling cash flow fuels her climb. 8. Control over taxes. Keep what you earn. Taxes can gut wealth, unless you outsmart them. Rich Dad used business write-offs and property depreciation to slash his bill. Robert did the same, deducting rental repairs and education costs. Miguel, a contractor, starts a side gig, writes off $5,000 in tools, saves $1,500 in taxes. He invested in a triplex. Controlling taxes keeps his money working, not vanishing. 9. Control over leverage. Borrow to build. Debt scares the middle class. The rich wield it. Rich Dad borrowed $80,000 to buy that $100,000 warehouse, made $150,000 profit. Robert used loans to snag properties. $2,000 down became millions. Jenna, a baker, takes a $30,000 loan for a shop. It nets $50,000 yearly. She pays it off in 3 years, owns an asset worth $100,000. Controlled leverage multiplies her $5,000 start. 10. Control over your legacy, beyond your lifetime. The rich think generations ahead. Rich Dad planned to pass businesses to Mike. Robert built Rich Dad for lasting impact. It's not just wealth, it's a system. Raj, a tech founder, grows an app to $500,000 value, sets up a trust for his kids. If he sells or keeps it, they inherit a cash machine. Controlling legacy secures the future. The 10 controls in action, from broke to boss. Robert ties these together with his story. Broke in the 80s, he controlled himself, no panic, lived lean, income/expense, timed buys, crash deals, built a team, Kim and pros, studied hard, info, diversified, properties and books, chased cash flow, rentals, cut taxes, deductions, leveraged loans, and aimed long-term. Rich Dad brand. It's a blueprint. Take Anna, a cashier with $2,000. She learns stocks, info, skips lattes, ratios, buys cheap shares, timing, asks a mentor, team, holds herself steady, spreads $500 to a side gig, diversification, earns $100 monthly, cash flow, writes off costs, taxes, borrows $5,000 for a rental, leverage, and plans to pass it on, legacy. 10 controls, 1 path. Your destiny. Grab the wheel. The 10 controls aren't magic, they're mastery. Rich Dad didn't wait for handouts. Robert didn't either. You don't need a fortune, just discipline. Pick one control today. Cut an expense, learn a tax trick, call a pro. Anna started with $2,000. Robert with a beat-up condo. Master these, and you're not just investing, you're commanding your future. Overcoming obstacles and myths. Of course, it's not all smooth sailing. Kiyosaki tackles common excuses. I don't have money to invest, or it's too risky. His response: it doesn't take money to make money. It takes knowledge. Start with what you have, a small business idea, a few $100 for a course. Risk, he argues, comes from ignorance, not action. He also debunks myths, like save your way to wealth. Rich Dad saw saving as a losing battle against inflation. Investing was the real path. Another myth: you need a high income. Kiyosaki started with nothing, proving it's about assets, not salary. The long game: becoming the ultimate investor. As the book winds down, Kiyosaki paints a vision of the ultimate investor, someone who doesn't just play the game, but changes it. Think of Elon Musk or Warren Buffett, building empires that reshape industries. It's ambitious, but he insists anyone can aim for it with time and discipline. He wraps up with a call to action: don't wait for permission or perfection. Start learning, start doing, and surround yourself with a team. Rich Dad's Guide to Investing, he says, is a guide, not a guarantee, just like Rich Dad's advice to me. It's up to you to take the wheel. Conclusion: a mindset shift for a richer life. So what's the takeaway from this hour-long dive into Rich Dad's Guide to Investing? It's not a step-by-step manual. It's a mindset revolution. Kiyosaki and Lechter argue that wealth isn't reserved for the lucky or the privileged. It's a choice you make through education, experience, and bold moves. The rich invest in themselves first: their knowledge, their networks, their ability to see what others miss. They don't chase security, they chase opportunity. Reflecting on the book, it's clear Kiyosaki's strength lies in inspiration, not minutiae. Critics might say it lacks specifics. Where's the stock ticker list? But that's intentional. It's not about copying his portfolio. It's about building your own. His own life, from homeless to multimillionaire, backs up the message: this stuff works if you work it. For you, the listener, the challenge is this: will you stay average, or will you step into the 10%? Pick up a financial book, start that side gig, talk to a tax pro. The path to wealth starts with one decision: to think and invest like the rich. Thanks for joining me on this journey through Rich Dad's Guide to Investing. Now, go make your money work for you.
I hope that you've enjoyed this video, and please remember to subscribe to receive notification of upcoming recordings. See you in next video.